Good afternoon, students. Today we are going to talk about valuation of goodwill. So in this valuation of goodwill, we are going to talk about the balance sheet, how they will calculate the net profit of the company. So in this problem, they have given balance sheet and liabilities and assets they have given. So in this liability they have given the share capitals, fully paid, profit and loss, sundry creditors and bank overdraft, and also they have given a dividend equalization fund. Then land and building, plant and machinery, stock and sundry debtors also they have given. And below they have given about the net profit of the companies for the years of 94, 95 and 96 and 97 and 98. So and also they have given the depreciations valued for plant and machinery, building, and they have given. So the next they asked to prepare the reasonable capital and the company's valuations. So for that we have to calculate the computations of goodwill. So before going for the computations of goodwill, we have to take this calculation of average capital employed. So average capital employed should be taken. So for that we have to take land and building, the value increased, then plant and machinery, the value increased. That means with the adjustments, if the value is increased, we have to take, if the value is decreased, we have to take with the depreciation. So according to the adjustments, we have to take the assets, net asset value. That means if you are having any depreciation in land and building, that should be deducted. If the land and value is appreciated, that is increased, that amount should be taken. Likewise, we have to take land and building and plant and machinery. For this both only there is an adjustment. Rest of the stock and sundry debtors, there is no adjustments. So as usual we have to take the net asset. Then less external liabilities. External liabilities, sundry creditors, they have given 2,31,000. Then bank overdraft, they have given 60,000. Provision for taxation also, that is an external liability, that is also given 1,35,000 they have given. So if you are able to notice it, these are the items is given in the liability side. So for that we have to take that one. So that is all these items, sundry creditors, bank overdraft, provision for taxations we have to take. Then net assets or capital employed amount is this total of net asset minus external liability. So that should be the net value of capital employed. That means net asset of capital employed. So with this they have given half of the net profit is taken over. So that means the half of the net in this information itself they have given additional information. They have given calculate the company's shares after taking into account, and they reveal the value of fixed assets and over the own valuation of goodwill based on 4 years of annual supervisions. And also they have given, that means they have given, that is last year 1998, the date is given. So date is, that means the view of nature of business, it's considered to be a reasonable and attain the capital. So that means the half of the net profit should be taken as a deduction of all working capital. So that we have to take the less, that is the last year or a profit, half the amount should be added. Last year net profit is 1998 net profit is 2,85,000. That should be added in the current working year. So that should be half of the amount. Then average capital employed is less than, that is less of net profit of the current year. Half of the year should be taken over. So that current average capital employed is 21,436. So this is the net amount we have to calculate. Once again, ma. So average capital employed is 21,46,500. So now we have to calculate the normal profit. So the normal profit formula is average capital employed into normal rate of returns. So I'll repeat the formula for normal profit. That means average capital employed into normal rate of returns. The normal rate of returns already given in the question is 10%. So what is the average capital employed we have found is 21,46,500. That should be multiplied. 21,46,500 into 10%, you will be getting normal profit. Then we have to do the average profit. So average profit is total of all the profit or the 5 years they have given in the question. That means all the 5 years profit is given in the question should be taken over. So the total of the 5 years average profit is 13,98,000. That should be divided by the 5 years. So 5 years means, so the total amount is 2,79,600. Then we have to do a super profit. The super profit formula is average profit minus normal profit. So average profit we have found is 2,79,600 is an average profit. That is then minus normal profit. We have found the average profit total is 2,79,000. The total of all the year profit divided by 5 is the average profit. Already we have found the normal profit. That means average capital employed into normal rate of return. So that is 2,14,650. That both should be deducted. That is called super profit. Again I will repeat the super profit today. Formula average profit minus normal profit. So that shows that 64,950. Then we have to find the goodwill. So the goodwill amount is goodwill is super profit into number of years purchase. Already in the question itself they have said only for 4 years. The question itself they have said only for 4 years of purchase we have to take. So that's why we have calculated the current year. That's why we have calculated the current year profit should be half of the year should be deducted in the computations of goodwill. So now we have to calculate the goodwill. The goodwill is super profit into number of years purchase. Super profit is 6,64,950 into number of years purchase is 4 years. The total of goodwill is 2,59,800. Then we have to calculate the valuation of shares. The number of asset as above is 22,89,000 is given. The goodwill is 2,59,800. The total asset value is 25,48,800. So now we have to calculate the intrinsic value of above. So the total of 25,48,800 divided by 15,000 shares is per share rate is 169 rupees, 92 rupees is the answer. So this is what we have to calculate the average capital or the average calculations of goodwill. The valuation of goodwill should be returned. So if they have given the goodwill, then assets and liability from the balance sheet, what else we have to do? First we have to do is a computation of goodwill. Then we have to calculate, add all the net assets. If there is any depreciation or any increase in asset revalue, that should be taken over here. Then less external liabilities, all the external liabilities should be deducted. For this, net asset capital employed is given. So in this problem they are asked to take only 4 years of purchase. So we are taking the current year profit, the half of the year should be deducted in the computation of goodwill, because they asked to take only for 4 years. That's why we have taken the half of the current year profit should be deducted here. So if they are not given for that 4 years, simply we can take 5 years, the whole 5 years. So there is no need to calculate here as a net profit for the year of 1998. So in this problem they have insisted to do it for only for 4 years. So the 5th year of the profit should be, half of the amount should be deducted here. Then only we can get average capital employed. Then we have to calculate the 3 formulas. First is normal profit. So normal profit is average capital employed into normal rate of returns. Then second formula is average profit of total profit is total profit, or we have to add all the 5 years profit divided by 5. Then super profit is average profit minus normal profit. When we have to find the valuation of goodwill, super profit into number of years. So up to this it's very important. So we have to calculate all these things. If you want to know the value of share per share rate, then we can calculate net asset plus that is goodwill. Then we will get a net asset available for the equity shares, that should be divided with the number of shares, that is 15,000 shares is given. So then only we can get the per share